Hey, in this video, we're going to discuss what a mortgage is, how a mortgage works, and the different components that go into a mortgage. Just imagine a society without a mortgage. It doesn't exist. Mortgages are highly integrated in our daily lives. It doesn't matter if you rent or own a home, understanding the benefits and disadvantages of each will help you make a better decision. So tune in. In this show, we like to educate as many people as possible on entrepreneurship and investing for value. If you like this content and would like to get more content just like this, don't hesitate to hit that subscribe button. So, let's get right to it. So the present question is, what is a mortgage? A mortgage is an agreement that allows you to borrow money from a bank or similar organization in return for some collateral. So you go to the bank says, hey, I'll give you $400,000. And you say, okay, no problem, I'll take your $400,000. And you use that money to buy a house with it. In return for that $400,000, the bank asks for collateral. That collateral is your house, meaning that if you do not pay back that loan, or if you do not pay back that amount of money that's owed, or if you violate the terms of the mortgage agreement, the bank will proceed with what they call a foreclosure process. There is a difference between a loan and a mortgage. A loan is completely different from a mortgage. A mortgage is requiring that you have some collateral in return for the money that's given to you. A loan, there is no collateral. You can borrow money from a friend, you can pay it back with interest, and that's it. Now, let's say you violate the agreement of the mortgage. What happens is the bank will start a foreclosure process. That foreclosure process is a legal proceeding to take possession of your home because you violated the agreement of the mortgage. Next, we have interest rates. An interest rate is the proportion of a loan that's charged to the borrower for taking out that money. So a mortgagor is not going to freely give you money without having some benefit from that money. So they call it interest. Interest rate is something that is expressed as a percentage. So let's say if you borrow $500,000, you will have to pay back 6% on that, which is $60,000. Now, the lower the interest rate, it will encourage homeowners to take out loans to fix out their homes, or it will encourage home buyers to buy homes. Have you ever heard of this term called the Fed rate? The Fed rate controls whether or not the interest rates are low or high. Higher interest rates will disincentivize homeowners from taking out loans against their property, and also disincentivize home buyers from buying homes. Now, you have two different types of interest rates. You have fixed interest rates. Fixed interest rates mean that the interest rate that you establish between the borrower and the mortgagor, it means that that will not fluctuate. So let's say you lock in an interest rate of 4%. That 4% will stay at 4% for the term of that loan. So you're locked in. Now, however, you have what they call a variable interest rate, which means that that interest rate can fluctuate for the time of that loan. So in the real estate world, it's always best to get a fixed interest rate. It will save you more money down the road, or it's just less risky, because if that interest rate fluctuates, you don't know, or you can't predetermine what you'll have to pay at the end of the month. So real estate investors typically love to get the fixed interest rate because it's better for them. And the last thing with this video is amortization. Amortization is the act of gradually decreasing the initial cost of an asset. So if the term is 30 years, you would have paid off that $400,000 loan, or whatever the price or whatever the cost of that loan is over 30 years. If it's 15 years, over 15 years. So every single month that you pay your mortgage, you pay a percentage of the interest, and you pay a percentage of the amount of the asset. Over that span of time, you would own a house free and clear. The only thing you'll be on the hook to pay for is taxes and insurance. That's it. Now, with respect to the types of amortization mortgages to get, I like 30-year mortgages. They're the best. 30-year terms are the best because every single month I'm able to keep more of the money. Now, the negative to that, or the downside to that is you pay less over time on that asset. So that means if, let's say, if you do it in 15 years, you would pay more up front to pay down that asset in 15 years, and vice versa with 30 years, or even if it's 10 years. So I personally like it because I'm able to generate more cash flow. I'm able to generate more cash flow every single month, and I like to use that cash flow. But everybody has their own strategy. You have a lot of real estate investors that use a 15-year term loan because they want to pay down the asset as quick as possible, and they don't really care about the cash flow that they're going to receive at the end of the month. So that's their choice, that's their prerogative. As an investor, you have to choose what you think is best. For me, I like the 30-year mortgage, again, because I'm able to receive more cash flow at the end of the month. I don't mind paying down my asset over that 30-year mark. Now, also, another thing to consider is that the quicker you pay down your asset, the more equity you'll have in your property. What happens is every single month that you pay down or gradually pay down on the asset, your equity increases. So you're able to leverage that equity to refinance, or you can sell the house. Whatever you want to do with that equity is there. If the term is 30 years, then it'll take a longer time to build that equity that I would like. Now, that's not to mention equity that will appreciate on the property. That's something separate from the equity that you build just by paying down the debt every single month. That's granted, because in the inverse, that house could go down in value. But if you follow the prudent steps on how to invest, that won't happen. So these are 4 powerful aspects of how a mortgage works, what a mortgage does, and the different components that go into a mortgage. Tune into part 2, because there we'll explain more in depth about other aspects of the mortgage. Until the next time, have a nice day.